I want to spend a few minutes today to talk about foreign exchange. When we looked at Hoffmann La Roche, their accounts were in CHF or Swiss franc. The statements of Alibaba and Sinopec were in CNY. The Chinese yuan. Toyota were in Japanese yen. And for Citibank and GE, the statements were in US dollars. As your macroeconomics class might have explained, in an economy we barter one good or service for another. Bank debt that's due on demand and exchanged between banks through bank deposits with the central bank is the most liquid good in all market economies. Foreign exchange is the exchange of one central bank's deposits owned by a commercial bank for another. Foreign exchange rates are prices. Consider a bowl of noodles. We normally give the direct quote on the bowl of noodles. We say that the noodles costs renminbi 16 per bowl. We do not usually give the indirect quote. The indirect quote would be bowls 0.0625 per yuan. We tend to think in direct quotes. So the price of currency in terms of another currency is the direct quote on that currency. The difference with currencies, however, is that one country's direct quote is the other country's indirect quote. From a Chinese base, the amount of Chinese yuan required to buy US dollars is the direct quote on US dollars. So Chinese yuan 6.25 is the cost of the US dollar to us. From a US dollar base, the direct quote is US dollars 0.16 per Chinese yuan. That's the cost of a Chinese yuan to them. The foreign exchange market is, as you might guess, the largest market in the world. It's a 24-hour over-the-counter market centered on the UK, the US, Singapore, Japan, and Hong Kong. When I say it's an over-the-counter or OTC market, I mean that it's not on an exchange, such as a stock or bond exchange or a commodities exchange. It's a wholesale market, so the minimum quote is US dollars 1 million. Slightly over half of the trades are electronic. That's an increase over the last 3 years. 3 years ago, only about a third were electronic. And the market is dominated by banks, brokers, pension funds, insurance companies, hedge funds. My data comes from the Bank for International Settlement Triennial Survey. This survey was completed in April 2013, and you can see that non-financial participants in the market only account for about 1/10 of the market. The rest are banks and other financial institutions. There are 3 types of transactions that dominate the foreign exchange market: spot, forward, and swap. Spot transactions are the price of foreign exchange contracted now for immediate delivery. Outright forward transactions are the price of foreign exchange contracted today for some delivery at a specified future time. The foreign exchange swap is essentially a derivative. It's a derivative which is identical to the simultaneous purchase of foreign exchange spot and the sale of foreign exchange forward. It's also identical to lending in one currency and borrowing in the second currency. Let's look at the turnover of the foreign exchange markets. I said that it's the largest market in the world. This gives the daily turnover in billions of US dollars per day. And as you can see, the turnover is about $5.3 trillion. Now, global GDP is about $75 trillion, so the foreign exchange market turns over the world GDP approximately 25 times per year, or once every 14 days. The largest transactions by volume are foreign exchange swaps. Spot transactions are slightly below foreign exchange swaps at about $2 trillion per day, and outright forwards are only about 1/3 of the amount at $680 billion per day. Currency swaps and options are far less than these 3 major transactions. Currency swaps account for about 1% of transactions. A currency swap is like a foreign exchange swap, but where a foreign exchange swap has only two pairs of payments, one at the beginning and one at the end of the transaction. Currency swaps have multiple pairs of payments. Foreign exchange options account for about 6% of the market. Although there are well over 100 currencies in the world, and although 53 currencies took part in the BIS survey in April 2013, only a few currencies dominate the foreign exchange markets. We've shown here the 12 currencies, each of which accounts for more than a 1% share of global trade in foreign exchange. And the top currency is the United States dollar, accounting for 87% of trades. It's followed by the euro, accounting for 33%, and the Japanese yen, accounting for 23% of trades. The Chinese yuan accounts for 2% of trades. And if you add up these percentages of trades, you can see that the top 12 currencies account for 185% of trades. The reason why there's more than 100% of trades is that each trade has two legs, two currencies. So if you added up all of the 53 currencies, you'd end up with 200% of trades. The omitted 41 currencies just account for 15% of trades. Each foreign exchange transaction involves two counterparties and two central banks. Each bank receives clearing deposits from one central bank and gives up clearing deposits with the other central bank. But as banks seldom have clearing accounts with two central banks, they use correspondent banks to take and receive central bank payment. So the cores of payments in foreign exchange are the central banks of the appropriate currencies. Central banks are extremely important to finance, so I want to say a few words about them, although they're more properly covered in a course on central banking or macroeconomics or money and banking. Central banks are banks whose liabilities that are owned by clearing banks constitute the bulk of high power money or the monetary base. Because clearing banks' deposits are the money supply, and because clearing banks, for liquidity purposes, maintain at least some fraction of their own deposits in the form of highly liquid clearing deposits, central banks can influence the total money supply by issuing and redeeming clearing deposits. The central bank is under the control or guidance of the government. The central bank serves as the lender of last resort, providing liquidity to banks and allowing solvent banks to make payment. And the central bank oversees the financial system and regulates commercial banks. The Central Bank of the United States is the Federal Reserve System. The Central Bank of Europe is the European Central Bank and its associated central banks of member countries, and the Central Bank of China is the People's Bank of China. First of all, their size. They're roughly the same size. The Fed has assets of $4.5 trillion. That's 70% larger than the European Central Bank, which has assets of about US dollars 2.65 trillion. The People's Bank of China is about 20% larger in terms of assets than the Fed as of December 31st, 2014, with $5.46 trillion. Their asset compositions, however, are quite different. People's Bank of China's assets are mainly in foreign exchange. The European Central Bank has about 29% of its assets in foreign exchange denominated assets, and the rest of its assets are spread between claims on banks and securities, and the Fed has almost all of its assets in securities. In terms of liabilities, their composition is more similar. These are the dollars or the renminbi or the euros that are kept in the wallets of the residents of the country. An important part of the liabilities of the three central banks are the claims of banks and other monetary liabilities. Now, among these claims of banks and other monetary liabilities are the clearing deposits through which payment is effected in the US dollar, the euro, and the renminbi. Exchange rates are very important. They add complexity and risk to the treasurer. and they add additional services that banks can provide to companies. They affect the competitiveness of firms. When the currency of your country appreciates relative to another country's, your country's goods prices rise abroad and foreign goods prices drop in your country. This hurts domestic producers and it makes domestic businesses less competitive. It benefits domestic consumers and it benefits foreign asset purchasers. In summary, foreign exchange is the largest and most liquid market in the world. Foreign exchange is critical to international business. Foreign exchange prices presents risks and opportunities, and an analysis of foreign exchange movements brings macroeconomics into finance.